Right, can you hear me okay? I apologize, I'm not going to be complete Cassandra. So I'm going to try and offer some suggestions about what might change. I haven't got a PowerPoint, so I literally can spin through some observations for you. And I'm going to try and talk a bit about what I think is a kind of a more structural problem in the sector and what the sector can do about it and what investors can benefit from. James has already put a very good, oh my God, terrible photo of me. James has already put a good chart up, which sort of shows you the level of discounts in the sector. I think it's quite, let's put some flesh on the bones of that. There are 26 funds at the moment that are trading over 40% discount. That's pretty shocking in my book, yeah. That tells you there's a really big problem on the horizon. Discounts are, the discounts are, particularly for the infrastructure funds and the real asset funds, are structurally very high, unprecedented levels. We've basically only had one IPO in the last 12 to 18 months. And if we judge what's going on in the bond market at the moment, one of the narratives is that one of the reasons why investment trusts, particularly real asset investment trusts or income investment trusts, have had a real problem is because of increasing bond yields. Well, there's not going to be a lot of help and salvation coming on that front for quite some while yet, because we're already seeing the bond reset that's going on at the moment. 10-year gilts and 10-year T-bills, T-bonds are shooting up in their yield, and it shows no sign of ameliorating. And in fact, if you talk to bond market analysts, they reckon that there's probably further to go. We could see not the 4.5% level broken, but the 5.5% level broken in some analysis. So that bond environment is unforgiving for investment trusts, particularly income-oriented investment trusts. And I think the investment trust sector has to wake up to the fact that we may not get any IPOs or, frankly, much fundraising away for another 12 months. So, and even the ones who've raised money in the last 6 months are now all in difficult waters. Brevin Howard's fund, BH Macro, basically raised a load of money and has shifted from a massive premium to a pretty substantial discount. The fund that I'm on, which is Gresham House Energy Storage, as non-exec director, we raised 50 million. And now we're trading at, I can't remember what it is now, 35% discount. We were trading at a 15% premium. So pretty much everything that's been raising money is also basically been absolutely walloped in the last 3 to 6 months. So there's a deep structural factor at work. And it's quite possible, the reason I'm sort of hitting the alarm bell is that if we believe the higher rate for longer argument, which is being put about at the moment, which is that we're likely to see interest rates stay high for longer and we're likely to see bond yields stay high for longer, then the sector's got a real problem on its hands. And I think it's most appreciable and most obvious in what I call kind of growth assets or growth real assets. The quite remarkable turnaround I've already hinted at, for instance, in the battery space, in grid, which has moved from a kind of, I said, from a 15 to 35% discount. In the digital infrastructure space, D9 has got its own idiosyncratic problems. But even Cordiant, which is, I think, pretty conservatively run, well-run outfit, is now trading at a 35% discount. If that figures roll up, I'll be corrected. We've got Hypnosis, technically not really a growth asset, but I suppose you could say it's growth of some NAV from the royalties business along with a steady income stream, trading at a colossal discount and embroiled in a kind of boardroom dilemmas. So even the growth assets bit of the real asset space is in deep, deep, deep trouble. And these are the kind of funds that should really be producing NAV growth, and in fact are producing NAV growth. What was remarkable, for instance, in D9's case, Digital 9, which is digital infrastructure business, was that I think they put out interims last week. They obviously got their own idiosyncratic problems, but if you actually looked at their operating earnings, along with management expectations, they're actually increasing. They're actually doing roughly what they say they are. They have their own financial engineering and structural problems. Again, Cordiant, pretty solid business. Most of the businesses in the growth asset space, the growth real asset space, are actually in their operating basis doing pretty well. The market has basically derated it, doesn't believe the story about NAV growth any longer. That's the problem. The problem is that investors look at it and are promised 10, 11, 12% NAV growth across the cycle, distributed between income and capital gains, and they don't believe the capital element any longer. So that is a very real problem. And the lack of IPOs also, I think, is a real problem. It's something I talked a bit about in my Citywire column a couple of weeks ago. The great strength of the investment trust sector has been its ability to be able to get new ideas on the ground, off the ground and on the market, and raise substantial amounts of money. That is its brilliant genius. And I think that the way that the investment trust sector over the last 20 years has reinvented itself from a largely purely equity play into a kind of combined real assets and equity story, I think is remarkable. And I think it's all credit to the whole investment trust sector. It's been quite the most innovative sector in Europe. 2 or 3 years ago, I was doing a couple of events in Switzerland, and you go to the Swiss events, particularly around sustainable investing, and you talk to investors, and they all go, "Well, what's London like? What can we do in London? We'd love to do something in London because London is the most innovative place to be doing stuff." And therefore, that's London's great ability. That's London's great strength. And the lack of IPOs is a real problem, because if I were a new manager at the moment, I wouldn't list in London. I couldn't list in London because I can get an IPO away anyway. But I definitely wouldn't come to London because London's shut for business. Now, we all know London's shut for business for lots of other reasons as well. But the market for innovative new asset managers coming to the UK market and listing a closed-end fund, I mean, is in a dreadful state. And I definitely wouldn't come because it's just too much pain and agony. And the problem is, rearing on the outside here is a new threat. I think you're going to talk a bit about it later on this afternoon, James, which is active ETFs. Now, for full disclosure, I set up a business called ETF Stream, who one of my people are coming along and talking this afternoon. So I'm partly talking my book. But if any of you didn't notice, that RISE, R-I-Z-E, was taken over by a small firm that I'm sure none of you ever heard of called ARK Invest, which is one of America's most progressive, not terribly successful in terms of returns at the moment, but certainly one of the most aggressive marketing businesses I have ever run into. Kathy Woods is a miracle. I mean, she is a remarkable person. Love her or hate her, I personally admire her enormously. I don't trust her investment advice, but I think she's a remarkable marketeer, and she's built a fabulous business, and she's got countless tens of billions, and they're still getting inflows into ARK Invest, the ETFs, which is quite remarkable. Yeah, but considering how appalling they are in terms of performance. She's still getting remarkable inflows. So they've just bought RISE off Martin Gilbert's Asset Co business at a vastly reduced price, I might point out. And I can pretty much guarantee you that she has got in mind a complete assault on Europe. She's going to go after the Scottish mortgage market, absolutely, in big time. And she's going to be very aggressive about it. And she's not the only one. Again, it's gone unnoticed, really. But JP Morgan have built up a very successful active ETF business now, and I can't remember the exact number, but one of their active equity ETFs has already clocked £2.5 billion in assets. That's a sizable number, yeah. And once those young, interesting, innovative fund managers who are looking to launch strategies within the kind of listed fund framework start to look at active ETFs and start to think through, well, actually, if Kathy can do it over at ARK, or what is now RISE, if JP Morgan can do it, we can do it. And at that point, the vitality that is so crucial to the listed investment trust sector or the listed closed-end fund sector begins to drain away. So I think it's time that the whole sector wakes up and begins to smell the coffee and begins to realize there's a real problem here. And that if we have a higher rate for longer environment, then actually this problem could persist for a very long time. And if nothing else, that higher rates for longer and thus it persists for a longer time environment also means, as I pointed out in the Citywide column, that actually talented staff who work in the investment trust sector, particularly amongst the brokers, particularly amongst the advisors, amongst the lawyers, begin to drift away because there's no deal activity. They go and work on other desks. I have it on good authority that one of the big investment banks has just transferred about half of their funds advisory team to other bits of the business, including debt advisory. I don't blame them. If our investment bank and the bulge bracket bank, I do the same. So what can we do to sort of fix the problem? Because I don't want to come across as a complete Cassandra and say that the sector's doomed. Was it Fraser in Dad's Army, wasn't it? There are some practical things that have been suggested. Consolidation, I think we all accept, is probably necessary. There are probably too many underperforming funds out there, which basically don't really deserve to be in existence any longer and need to be consolidated or closed. And we've already seen waves of that happening at the moment. I think the other thing, which again has been much commented on, is I think we absolutely need to see boards step up to the mark. I sit on a couple of boards, and I'd like to think I'm fairly aggressive on the boards that I sit on. I don't take it for granted what the managers always tell me. And I think we've seen too many cases where stuff has happened where, frankly, the board is asleep at the wheel. And strategic decisions have been made, which really the board should have questioned and said, no, that's really the wrong thing to do. Really, or there's a confused strategy, or there's a set of conditions within, for instance, go-to shop clause that we should never have accepted. Not mentioning any funds in particular. So boards have been asleep at the wheel, and they really do need to wake up. And because if nothing else, one of the great selling points of the investment trust sector are those independent non-exec boards. So let's see them work. I'd also like to suggest 2 or 3 other things that might help. I think, if I'm honest, I think that the sector has binged too much on real assets and income opportunities. I think it needs to get back to some of its basics and do more equity funds. I think one of the great strengths of the ETF model is that ETF managers turn around and say, you know what, active stock picking doesn't work. It's too idiosyncratic. We're living in more efficient markets, doesn't work. And whilst that is generally true, it's not always true. And there are certain sectors and certain strategies and certain ways of doing things where active fund managers absolutely can still add value in a very difficult, very competitive market. I don't know if any of you have seen the charts from the American mutual funds flow industry, which compares actively managed mutual funds with passive funds. And the gap is absolutely yawning now. Passive funds are absolutely trouncing active funds in America at an astonishing rate. We're not there in Europe, and we're certainly not there in the UK. So that makes active fund managers really have to think about what it is that they can do. And I do think they can do a lot. And I think some of our most standout successes in the sector over the last 10, 20 years, Scottish Mortgage, let's just say, Scottish Mortgage and what James Anderson did, fantastic timing. But what he did at Scottish Mortgage was remarkable. He built up a behemoth, and all credit, he did it via a very active stock picking fashion, which would combine private and public assets. That kind of vision is absolutely can work, and it goes out of favour at some points in the cycle. And clearly, Scottish Mortgage at the moment is having a terrible time for all the reasons that we know. But that can work, and therefore, I think that if we get back to our basics around focusing on equities, and beginning to work out where there's real opportunities. And I was delighted to see that Ashok, for instance, raise money on a global emerging markets mandate, even if I don't believe in global emerging markets. But that was absolutely the place where we should be seeing more innovation. I'd like to see more innovation, for instance, in the small cap sector in the UK and the mid cap sector. The UK is ridiculously cheap. UK equities are blindingly cheap. And I think that good managers out there can produce real alpha over the long term. I think that throughout the equity sector, particularly in sectors, so one of the most successful things that's been done in the ETF sector is thematic ETFs. I think they're an interesting innovation. I think that they have challenges. And I would like to think that active fund managers can do an awful lot around thematic investing. Already Polar, you've got Nick Bryant's coming up later on. Polar have got, for instance, a robotics and AI fund, which has done pretty well, taking a decent amount of money. And I'd like to think that we could see more interesting ideas come out in the whole kind of thematics or sector-specific or cross-sector space. So a refocus, going back to basics, sounding like a Conservative Party leader here, going back to basics and looking at the equity space, I think is a really good idea. I also think that the sector needs to think long and hard about how it consolidates and how it begins to be more innovative. And one of the ideas that I'd quite like to see the sector begin to develop is, I think Daniel Godfrey tried an interesting idea a while ago, which is he tried to build a kind of mutual investment trust, which would invest across sectors. And one of the things that when I talk to investors, particularly younger investors, they're really very keen on is multi-asset investing, be that on a defensive nature or be that on a growth nature. So if you look at the robo-platforms, for instance, the robo-platforms are taking significant amounts of flow based on the idea, along with Vanguard as well with their life strategy funds, on the idea that they're doing multi-asset class allocation. So they're trying to solve all of your problems and put it in one magic bullet, one magic structure or fund. And we've got the basics of the building blocks of that in the investment trust sector. People like Witten and Alliance Trust have done a great job in building diversified global equities portfolios. I'd like to think that we can begin to do something more cross-asset, multi-asset solutions. And we know that works because the defensive versions of that, people like personal assets, or funds like personal assets, funds like capital gearing, to a lesser degree, I suppose, BH Macro, but that's the hedge fund. They already do that kind of multi-asset appeal. And that's really very, very attractive, I think, to investors at the moment. And then the last thing I'd like to see the sector do related to that is I'd really like to see the sector reach out to younger investors, because I'm desperately worried that within the next 15 years, about half of our investor base will have died because of the age profile of our investor base. I talk a lot to investors. They email me, usually complaining about some of my ideas. And I'm struck by the fact that we're suffering from an aging demographic, and we really need to do something about it. And yet I noticed when I go on the big robo platforms, things like free trade and all that kind of stuff, there's an enormous enthusiasm amongst younger investors for things like Scottish Mortgage. You know, Scottish Mortgage quite often is number 3 or number 4, even now, on something like free trade's trading platform. And that tells you that a lot of younger investors are really interested in investing. The problem is that they've all been educated in ETFs. They're very ETF friendly, very ETF focused, because they've been told it's all about cheapness, it's all about cost effectiveness. So therefore, they're quite up on their ETFs. And when I introduce investment trust to them, they sort of go, oh, well, that's quite interesting. I don't know much about that. So one of the things I'd really like to see AIC do is start to reach out to younger investors, and actually all of us can do this, and begin to come up with different ideas that can appeal to people on the big direct platforms. And I'm going to finish on that point. Because the big direct platforms are the future. I think the problem is, I think the investment trust industry has had 3 legs to its support. It's had institutional buyers who probably won't go away, but are always difficult. They can be quite tricky to handle. We've always had the private client wealth broker market, and then we've always had the retail market. The problem with the private client wealth market is it's massively consolidating at a phenomenal rate. And the minimum level for an investment fund, we all know the numbers, we've all heard the numbers talked about, is probably now 500 million. And that basically rules out only that only really rules out all but a few listed investment trusts. And that consolidation is going to continue. And the reason it's going to continue is because fundamentally a lot of the wealth propositions that are out there aren't good value. They are still charging far too much money for what I think is poor service. And the problem is that as they consolidate, what the consolidators are doing, led by their private equity masters, is that they're encouraging them to adopt more and more centralized research and research and market making activities. They're basically using more and more data, they're using more and more technology, and effectively they are trying to fight the battle with the direct platforms. I'm of the view that they'll largely lose that. I think you'll see a few of the big wealth players do pretty well already. We've seen people like SJP doing very well. But I think a lot of the other wealth players don't have a strong USP, and I think they'll be competed out of the market by the direct players. And the direct players will basically push up the importance of retail for the investment trust industry. And therefore, I think the importance of thinking through how we engage with the end investor and retail investors, particularly as that aging group gets older, and how we engage with younger investors is probably the single most important challenge facing the whole industry. So I've literally got 5 minutes. If there's any questions, I'm happy to answer them. If not, I shall skedaddle. Any questions? Shocked you all, bored you all. There's always the internet. Rely on that.
So one is now that interest rates materially present, has it changed the broker?
That's a good question. Arguably, no. Obviously, you know, I mean, if you can get 5.5 or 5%, what's 2-year gilts? 4.89, something like that. 2-year gilts at 4.8, 4.9. Possibly, we might see 10 years go past 5, maybe in the UK. I don't know. Then obviously, clearly, the risk-free rate of return has gone up, yeah, and therefore any IRs that you've got have got to be pushed up. I mean, that is a process that's been working its way through the system. So that basically means that in income terms, anything that was paying 5 to 6% basically now in income I'll get around to answer the question there. In income terms, anything you're paying 5 to 6% a la hypnosis is in trouble. Growth assets. Well, I mean, really, the question boils down to whether or not you believe we are in a higher rate for longer environment, how much longer. So if you believe that we're going to see 10-year rates stay above 5.5% for the next 5 to 10 years, which I think unlikely, because I think that the debt levels that we have in society, and particularly at the governmental and corporate level, are too high to sustain 5+% yields for more than 3 or 4 years, then we would expect interest rates to quote unquote normalize back down to about 3.5%. And if you talk to economists at the Bank of England, who of course have been so fantastically accurate so far, if you talk to economists at the Bank of England, they reckon that the kind of natural long-term rate of interest probably is still down at, well, the real rate's probably down at 0 to 1%. So that they would expect interest rates to normalize, at which point, if you've got a growth asset that is paying 10 to 15% IRR, they're still valid. They still work. So I think it sort of depends upon what you think about what happened with bond rates. And I think if you think that bond yields are going to go down, then I think the growth case is still there. If, on the other hand, they're going to stay high and elevated, then kind of that gap between that growth IRR of 10 to 12% and the risk-free rate of 5 is probably a bit too narrow. Question? Just shout very loudly.
Given London's arguably shut for business, according to you, what do you think the extent to which the regulators or the government could help? And my reference really here is around cost.
Yeah, I know. Yeah.
Investment trusts and the level or unlevel playing field.
Unlevel playing field. Well, I think, I mean, that's part of what we've all seen the letters going out from the various investment banks about this. I agree entirely with the sentiments. I'm not convinced the government and even kind of less arduous cost disclosures is really going to solve the problem. And I think the problem is more deep rooted than that. I suppose that's my issue. My issue is that while going back, there are two answers to that question. While bond yields are very high, I think it's very, very difficult to sell anything with an income component. I just think that's just the reality of it. Yeah. So I think that affects any income producing asset. On the equity side, I am worried that effectively going back to my earlier point, we have a whole set of people who just lost trust and faith in the investment trust sector because I think they've seen serial mistakes and serial strategic errors. And I think no matter how much we try and fix the cost disclosure issue, which is, I said, I completely agree with the issue raised. I think it's about a loss of confidence in the ability of managers to be able to produce what they say they are. They say they are in the strategy. And I think that's really problematic. And that, I think, I'm struggling to overcome that issue, really. I think there's been too many failures and there's been too much underperformance. So even within, let me give you a classic example, biotech. So biotech, kind of not quite classic equity, but equities. You know, biotech managers have been promising that biotech is going to come up for a while, as have I. I've been a big fan of biotech for a while as well. And it's serially not. And most of the managers have underperformed on most levels. A few have outperformed, but they haven't delivered. And that's my problem, I suppose, is that too many managers have promised too much and failed to deliver. And therefore, no matter how much you improve the cost disclosure, I don't think it's going to overcome the fact that there's an awful lot of wealth managers out there who were burnt by investment trusts. And there's an awful lot of private investors out there sitting on very big losses going, why don't I buy an ETF? Fundamentally. So that's the reason I think there's a bigger issue than some of the kind of fiddling at the edges, which that's very important. I don't dispute that at all, but I think it's fiddling whilst Rome burns. Any other question over there?
Whether the new consumer duty value assessments could be an existential threat for.
Yeah, well, they've already been removing Fidelity, have been junking stuff off the platform at a fair old rate. Yeah, I was talking to the boss of one of the big platforms literally over lunch last week, And he said to me, David, I don't see how I don't see how a quarter of the investment trusts on my platform deserve to be there. I should just remove them. Short answer is yes. I think it's a real problem. And actually, I think it's a real problem because the ETF guys are crowing about it as we speak. I can tell you that for a fact. There's a bunch of ETF salesmen going around some of the private wealth houses saying, why have you got these investment trusts on this platform? Why haven't you got our ETFs? Because our ETFs absolutely tick every box on that. And once you have active ETFs kicking around, they've been held back because of all sorts of structural and regulatory reasons. But they're easily overcome, then watch it happen. In America, 2/3 of all ETF issues are now active ETFs. Now, they haven't taken much money. That's a problem. They haven't been an enormous success, but 2/3 of them are all active ETFs at the moment. So clearly they've worked out the kind of problems that are with the active ETF space. And ETFs are definitely taking advantage of that issue. I think I've probably run out of time.
Thank you
James,
very
over
much.
to you.